Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is closing the year of 2023 out with a 14.08% gain. The S&P 500 buy and hold investor has closed the year out with a 24.13% gain. Currently, our stock market strength color guard signal is green. Here are some past results, and I put in 2023's here since I'm closing the year out, and I put in my notes about how we did this year. And basically this summarizes that it's not as good as the buy and hold investor this year, but better than money market or CDs. We also have a very impressive equity curve for 2023, and I'll show you that in a second. Last week, the S&P 500 gained 0.35% for symbol SPY. We are up 9 weeks in a row, which is quite remarkable. We are totally expecting a red candle in the next 1 to 2 weeks. Who knows what size red candle we're going to get, but we're expecting some red on the screen. There were no trades last week. Here are some of the most recent trades that I've made for the model portfolio. If you want to see all the trades for the past 3 years, you can head over to this link. There'll be a link down in the description below, as well as for everything that I'm presenting today. We had 2 open trades that for the portfolio I'm closing out, so I can close out the year for 2023. We had 200 shares of SPY with a gain of $6,400. And we had an in-the-money covered call, which here it shows that we are taking a loss of $3,628. Here is the equity curve for the model portfolio for 2023. Here is the equity curve of the S&P 500 buy and hold investor for 2023. And here are the 2 equity curves combined. I was doing fine up until this point when I was waiting for a pullback in the S&P 500 that never came. I put the portfolio on a conservative approach, and that is what really prevented my returns from beating or surpassing the S&P 500. I was just too conservative. Here is the Fed Chair Jerome Powell. The last interest rate announcement was on December 13th, and they skipped for 2023. Now here is 2024, and we can see that the next announcement will be on January 31. Are we going to have a rate hike? Are we going to skip? Or actually, I need to change this terminology, because now what they're talking about is even cutting rates. The Fed chair has already announced he has an intention on cutting rates 3 times in 2024. The data hasn't even come out yet, but he has made that projection verbally. So that's one of the reasons why the market has been so strong over the past 9 weeks. All right, so here we are looking at the presidential election cycle theory. Now we're closing out the year 2023, the 3rd year of the election cycle. Historically, for the S&P 500, that equates to 16.3% return, and for the NASDAQ 100, a 32% return. President Joe Biden in his 3rd year, and next year will be President Biden's 4th year. Now, this year, the buy and hold investor is closing the year out at 24%, well above the historical average of 16%. Next year, the expectation is a 6.7% return for the S&P 500. So historically, we're not expecting the same year next year for 2024 as we had in 2023, and this was above historical norms. Now we're looking at things from the bond market, and we still, by the way, where I get my data from is bankrate.com. Bankrate.com must be on vacation because this is not updated. So the information is actually the same from 12/20/23, but we still have an inverted yield curve, and we still have rising interest rates. Still bad for equity investors. This is one of the prevailing reasons why I have been so conservative in my model portfolio for 2023. This is going to come back to bite us when this thing corrects and we go back to normal. 1 to 4 months after we go back and revert back to a normal equity curve, or yield curve rather, then the stock market is going to decline, anywheres from 5 to 20%. So I don't want to be caught with that, but this is still a little early, but it probably is going to happen in 2024. So you just cannot go pedal to the metal here, especially in 2024. That's my viewpoint. All right, now we're looking at the evaluation of the S&P 500 according to current market valuation, and we are overvalued by 52.9% above the historical average for the PE ratio. That puts us on a standard deviation chart of 1.3. So there's definitely risk, and caution is advised going long. Now, here is our friend Warren Buffett. We're looking at CNN Business Fear and Greed Index, and we are at extreme greed. Last week, we were at extreme greed. So caution is advised when you are at extreme greed. Now we're looking at the seasonality outlook, and for the month of December, following the month of November, which had this incredible green candle, another solid green candle for the month of December, closing the month out with a 4.57% gain. Historically, the S&P 500 averages anywhere from 7 to 10% annualized. This year, we closed out at 24.13%. Unbelievable, great year for the buy and hold investor. Okay, now we are looking at things from a long-term outlook, and this is a 20-year monthly chart for the S&P 500 long-term bull run. We are definitely still looking bullish. Everything is looking bullish. The MACD is positive. Slow stochastics is above 80. Everything so far on a long-term outlook is looking very good. Now this is an intermediate term outlook, 5-year weekly chart, S&P 500. You can see this very steep trajectory that we've been in with these straight 9 weeks up, which is, we're on a curve that's basically an unsustainable vertical curve. So this is going to come back down, probably finding support somewhere around here at this level here. Well, let's just say 450 or 455. So we should definitely see some support there. If that doesn't hold, then I would expect some support at 430 for sure. Now we're looking at a 6-month chart, daily candlesticks. There is your upward growth that we've had, and we are up here, and we seem to be kind of leveling off a little bit. MACD it's already crossed below its signal line. It's right at the signal line. You can see the numbers here. It's lower here than here, so we've crossed below the signal line, but everything hasn't really fallen apart yet. We have the Fibonacci retracements put in here. I didn't recalibrate them, but they're close enough. So at the 38%, we're looking at 449, and the 61 at 433. So the correction should come down somewhere between here and here. If it surpasses the 61.8, that would be pretty bad. That would mean that this was just a blurb, and we're going to be going even lower. So this pullback and the strength of the pullback and measuring the pullback is going to be extremely important to see how well things advance in the future. Now, this is a chart to show you on the MACD exactly what is going on. And I've got a 20-year chart here. Oh, actually, no, I don't have a 20-year chart. Here it's only going back 4 years. I actually did go back 20 years, and all your touches only happened within the last 4 years. Now, where the MACD is right now on the daily chart, I put red lines, how many times we've touched in the last 20 years, but you're only seeing a 4-year chart. And that's these red vertical lines right here. Pullback right there, pullback right there. So 100% of the time when you've reached these valuation levels on the MACD, you have some type of a pullback. This was an 8% pullback. This was an 18% pullback. And then you can see where it came close would be the other blue vertical lines, and you can see a small pullback here, a little pullback there, but it takes a little bit of time for these things to work themselves out. Now we are looking at a risk-on indicator with a ratio chart of the NASDAQ 100 to the S&P 500. We have a negative divergence. On the MACD here, you see that we've made a lower high, whereas on the ratio chart we made a higher high, meaning that the MACD is going to take this higher high and pull that down. So we do have an expectation. Also, looking at the wedge formation, we're at the upper end of the wedge formation. So there's a good probability that we are going to come down towards the lower half of this ratio chart. Now we're looking at another ratio chart, this time with the equally weighted S&P 500 RSP compared to the normally weighted. There's three charts here. So the ratio chart is in black and red. The S&P 500 is in blue. The equally weighted S&P 500 is in green. Now, the ratio chart's fallen off a cliff 3 times in the last 20 years. And when it does that, the blue S&P 500 has also followed suit, except in 2023. It did not follow suit, which is remarkable. So it's happened twice in the past, and maybe it just hasn't happened yet. It would, if this Fed has actually engineered a soft landing, that would even be remarkable. So a lot going on here, and there's risk definitely in this market. But we're in a bullish condition with the MACD being positive and with the slow stochastics being positive. The only thing that's concerning is that we did not have a good size correction or a measurable correction in the S&P 500, and we also, unless you want to call this that measurable correction, which is definitely different than what we've seen here in the past. You can see here it's just fallen off of a cliff. Here it just kind of steadily went down, and that was very small on a percentage basis and has already surpassed that. Now, we have gone sideways with the ratio chart in the past for a few months before we take off and then continue on to a nice bull market. So this is going to be the easy money to be made here and here. That's the easy money. So we're gonna make some serious cake there. I don't think we're there yet, but so definitely I'm going to have caution in my portfolio until we get past this point here on this chart. Now we are looking at the VIX, the volatility index, also known as the fear index. We are in the ultra low range. This is the low range, and this is the upper range. You're going to lose money when you're going up into the upper range, but we are still low at 12.45. So very, very low. MACD has even topped and is heading parallel. Potentially could even come back down. Now, over the short term, that's bullish. So there's still some legs in this market to go even stronger. Now we are looking at the Thinkorswim platform 5-year weekly chart, and we have standard deviations, +2, -2 in gold, +1, -1 in pink, regression line in dashed green. We are at 0.2 standard deviation on this chart with an upward trajectory. Now we are looking at the same chart, but this time it's 1-year daily. And you can see that we are very close to the +1. We're at 0.8 standard deviation. And now we're looking at the same chart, but now we're only going back 6 months of data. And on this chart, we're at 1.8 standard deviation. And I've got in here my sell zone. And here is my buy zone. Now, here is how I'm coming up with the color guard strength signal, and I've got it broken down into 2 portions for this spreadsheet. So in the upper portion, these are asset classes: S&P 500, NASDAQ 100, small cap, gold, silver, bonds, emerging markets, and world markets excluding the United States. To give us an overall picture how all the asset classes are doing. In addition to that, I've broken down the 11 sectors of the S&P 500 into each sector and to tell us how things are going. Now, from last week to this week, the asset classes remained the same, strong at 81%. And the 11 sectors of the S&P 500 actually grew in strength from 84 to 87. Here's how I came up with my data, in case you want to do this on your own. And then here is how we come up with the color guard signal. Now we are looking at a 1-year chart of the 10-year bond yields. We've come down, possibly reached a level that we're going to bottom at here and then come back up. If this comes back up, the S&P 500 will come back down. MACD has already made a nice curling bottom. You can see the histogram, how it's getting ready to go positive. So it looks like the 1-year chart of the 10-year bonds is going to go positive, and that's going to bring the S&P 500 down. We have a holiday on Monday. The stock market will be closed for 2024, Monday, January 1. I have just given you a ton of information in this video. Now comes our critical thinking. What are you going to do with that information? Well, here's my market summation. December 30th, 2023, the market summation, according to me, your friendly host Ken with SPY Trader Now. I'm just going to continue holding my in-the-money covered calls. The advantage of my position is that when the market does correct, I will be making dollars while the market is losing dollars. So basically, I'm going to stay the course and wait for this market to pull back. I am now starting a new year for the model portfolio because I'm closing out the old one. In my actual portfolio, I actually trade this portfolio, so I still have those 2 open positions. So I'm going to keep them and wait for this. But for the model portfolio, I am also going to be looking at things from a fresh perspective for 2024. I may even enter some puts, depending upon what the market does. But with the market being with the green color signal, generally speaking, that's not good advice, or it'll be very, very short-term trading is what that's going to be. That's not for a long term. That's just trying to catch a quick counter trend move. So our goal at SPY Trader Now is to beat the returns of the buy and hold investor, but in 2023 we did not achieve this goal. We will work very hard in 2024 to accomplish this goal. I hope you've gotten some valuable information out of this video. Hit that like button for me right now if you did. It really helps me and it helps the channel. Subscribe to my channel, Ken Trading. Ring that bell to be notified when I post a new video. I thank you and I wish you good trading.